Welcome to the Man from Macro, and this week we're going to be looking at the recent jobs data, which is posing a bit of a problem for both policymakers and investors alike. And that's because we're still in this post-COVID, post-fiscal world where the data sets themselves have been distorted beyond imagination, and also there's been this reimagining of how people approach work. And this is creating this uncertainty with the data. What we got last week was a better than expected non-farm payrolls. It was around about 336,000 versus 170,000 expected, with an upward revision to the previous 2 months. So on the surface, this looked like a strong data point, and bond markets sold off, yields went higher. But when we look into the data, it might actually be an indication that rather than being strong, we've actually got a weak labour market, still tight, but not strong. The two biggest components of the non-farm payrolls that improved were leisure and government. I want to focus really on that leisure bit because leisure suggests maybe these are part-time jobs, so people may be taking on extra jobs in order to make ends meet. And whilst we had that strong non-farm payrolls data, the household survey, which is interviewing individuals as opposed to employers, and employers look at any job as a single job, whereas households probably think about do they work during the day, and 2 jobs during the day is, well, effectively 1 job. The household survey was much weaker. It came in at around about 86,000. And as you can see on this chart, the divergence between the two was quite significant, although as you can also see, there's a lot more volatility in the household survey than there is in the employer's survey or the non-farm payrolls survey. But that again probably reflects the need or the volatility around people taking on extra jobs when they need to. And we also had some stronger data from the JOLTS survey. And again, we've talked about JOLTS before. This is job openings. We've seen this probably stronger than expected because often you get double counting. The same job can be offered effectively in multiple locations and therefore be double counted. But nonetheless, job openings remains relatively strong. So it looks like it's a strong data set. But that's not necessarily really the case. However, unemployment, although it's ticking up, still remains relatively low at 3.8%. And you need to see unemployment shooting significantly higher for a real recession to be confirmed, at least going back over the last 50 years. But what we've also seen is the Fed speakers over the last couple of days coming out and saying relatively reassuring things. And this is where the problem lies, in that every time we get Fed speakers saying we may be done in raising rates, you get a pullback in yields, which is great, but you also get a rally in the equity market. And firstly, we saw 2-year yields have quite a significant drop over the last few days on the back of these comments, because the 2-year yield is sensitive to expectations for interest rates. And we've got a little bit more of this at the end of the programme about why we use the 2-year versus the 10-year part of the yield curve. Now, the problem is that every time you get this reaction from the market continues to price in the pivot. The pivot today is now priced in for January 2024. But anyone who's been watching this will notice that the pivot has just been moving along through time. Only a few weeks ago, the pivot was still in September of 2023. And over 18 months ago, it was in February of 2023. All that happens is that the market has been pushing the pivot out, which is effectively a plateau. So should we expect interest rates to suddenly reverse, or should we continue just pushing it out and expecting really a plateau in interest rates? The other problem for policymakers is that every time you get any sign that interest rates might be cut, the equity market rallies. And you can see here the S&P has been bouncing off this significant trend line. It did marginally break through, but this trend channel that's been in place for a year is still very much in place. And until that has broken conclusively, we wouldn't be able to say that the equity market is under duress. And in fact, what we saw on the back of these comments is that volatility in both the bond market, this is the MOVE index, and in the equity market through the VIX, both fell back. And herein is the problem for policymakers. If every time they come out and say we might be done and risk assets react positively, then the chances that they might be done is diminished. And this comes at a time when some of the other indicators are starting to improve. If we look at the ISM survey, that's now at 49. It's been ticking up marginally. It's still in contraction territory, but at 49, it's getting closer back to that 50 level at a time when unemployment has not yet picked up. And if you may recall from previous episodes, it's only when you get a weak ISM and rising unemployment that you can tend to say that you are definitely within a recessionary type environment. So it's very difficult to suggest that that's where we are right now. And when we look at the equity market, we've got the S&P bouncing around the bottom of that trend channel, but it's 4,300. Are they really going to be cutting interest rates because the S&P has dropped to 4,300 when they didn't cut them when they were at 3,600? Now, we've also seen this market pull back, but it's less than 38% of the rally from that 3,600 level. People will say, but of course, CPI is rolling over, and therefore if CPI is low, there's more room for them to cut. But CPI is lagging, and CPI is nearly always a function of these other forward-looking indicators like sentiment surveys, like the ISM, and the equity market, and things like unemployment. Now, that obviously is lagging. But if unemployment stays sticky, around about that 3.8 to 4%, if the equity market stays around these current levels of 4,300, it doesn't really matter where we have on the CPI, because what really matters for policymakers is where they think the market might be in a year's time. And with strong equities, those corporates are likely to hoard their jobs, which means that you're going to get a base inflation that's probably higher and maybe a rebound inflation that comes sooner rather than later. So every time there is the risk or the opportunity for Fed speakers to say we might be done, we might be cutting, and the market reacts positively to that, the lower is the chance that the Fed will actually need to cut. In fact, they are more likely to be raising rates if equities stay high, unemployment stays low, even if CPI could manage to get to zero, which is highly unlikely in the short term. And obviously none of this is investment advice, it's just for engagement purposes. And we've just got a short film after this just explaining why is it that we use the 2-year versus the 10-year portion of the yield curve that everybody keeps talking about at the current moment.
Lots of people talk about the yield curve, but why do they specifically look at the difference between the 10-year and the 2-year yield? Well, firstly, the 2-year yield can be thought of as a sentiment indicator on where interest rates might be going. It's preferable to the 3-month part of the curve, which tends to follow where interest rates are and has little informational value. The 10-year part of the curve acts like a sentiment indicator for growth. In normal times, yields rise when the growth outlook is improving. Yields fall when the growth outlook is deteriorating. 10-year yields will also fluctuate with the outlook for inflation. It can therefore make interpreting the moves much harder. But for most of the time, we are really looking at the interplay between interest rate and growth expectations. And that's one reason why many people use the 2-year to 10-year part of the US yield curve.